Leadership is all about three things only. And I live every day. I'm a leader. I have an organization, people, culture, numbers. So as a leader, I have to be in the people development business, not necessarily in the management. So culture, making sure we have the right people on the bus and they're rolling in the right direction. And numbers, we just got to know the numbers. So leadership is about those three things: people, culture, numbers.
Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. And we believe that the key to scaling your wealth and compounding starts every single day with a mindset and practice of stewardship over ownership. Each and every episode, we're bringing on some of the world's best entrepreneurs, millionaires, and billionaires, where they share their wisdom and their secrets with us. And I'm excited about our next guest. He's out of the state of New York. And he is a specialist when it comes to real estate, investing, funds, syndications. He's got an extensive background. I had the privilege of meeting Mike a couple of years ago. He's also known as Big Mike. And we're going to be talking about the lazy man's 1031 exchange, lazy man or woman's 1031 exchange, and some cool things that potentially are on the horizon with bonus depreciation, and 100% back to the bonus up to 100%. It's about 60% this year and so much more. Please welcome to the show with me, Mike Zlotnik. Mike, how are you doing?
Hey, Brent. Hi, Brett. Thank you so much for having me.
Absolutely. For our listeners getting to know you for the first time, would you give us just a little bit more about your story and your current focus?
Sure. So I come from like the good old James Bond movie, From Russia with Love, but I'm not from Russia. I'm from Moldova. I grew up in the former Soviet Union. It was still Soviet Union when I left in 1989. So I'm a political refugee from the evil empire of the communist USSR, but I'm a U.S. citizen and U.S. patriot now. So I've been here since '89, U.S. Educated, live here in Brooklyn, New York, with my lovely wife, 4 monkeys and a cat, 4 kids.
Nice.
They're growing up very fast. They're no longer small kids. My oldest is a veterinary doctor student, but I'm still going through bringing up kids and enjoying that whole adventure of having kids. Almost all kids are 4 years apart, so it's kind of like it's a zoo.
That's awesome. That's great. I got 5 kids, so I get it, right? That's a lot. It's great. Well, congratulations on your success and the American dream that you're living. That's great. Let's dive right into the topic, which is the lazy 1031 exchange. So, what's the number one secret to this, Mike? And what would you say people need to know?
Well, let's start with basics. So 1031 exchange is a powerful way to obviously defer taxes. You do DSTs, so it's another super powerful ways. In many ways, DST can replace 1031 exchange, but there's an equivalent of 1031 exchange. The concept works, and you can apply it pretty much all the time. There's another way to call it, describe it. I just like what accountants call it. They call it pigs versus Pauls. So as you sell appreciated real estate, you get passive investment gain, a PIG. This is what accountants call it. And you could take that capital that you just got back from a sale of appreciated real estate and then reinvest it without doing 1031, literally invest it into something that gives you a lot of passive losses. So they call passive allocation losses, PALs. That's what the PIGs and the PALs. So the whole lazy 1031 is just don't do 1031. And you can even execute lazy 1031 when you blow up your 1031. You intend to do 1031, you have the time to execute, you failed to execute, time has passed. What do you do now? Well, the year you sold the asset, now acquire a new asset and run a cost seg, bonus depreciation. Of course, right now we are in a phase out of bonus depreciation, 2017 Jobs Act. But given the Trump is new sheriff in town, you got Republican Congress, they're gonna most likely, of course, we're not speculating, but probabilistically, from all the indications, they will extend and make it permanent. 2017 Jobs Act, and that means 100% bonus depreciation comes back, which enables real estate investors and folks like us to structure the deals with outsized depreciation benefits through bonus depreciation, cost seg, and that's the lazy 1031 in
Yep.
a nutshell.
Great. And we kind of break it down and do it real slow. That was a great overview, Mike. And so what we're saying, everybody, is you're selling an asset that has huge capital gains taxes, And instead of having to do a 1031 exchange or even a deferred sales trust or a Delaware statutory trust, if in the same year that you sold the asset, you invest into another asset that can produce what's called PALS, passive allocation loss, better known as, let's call it bonus depreciation and cost seg, right? Where you're accelerating this through a cost seg study, such as like an apartment complex, such as a real estate, industrial property. It could be other things too, but those are the ones that me and Mike typically like, right? Real estate stuff. And in that scenario, you can get a loss that can offset your capital gains tax, right? And this is really important. It's got to be the same year, right? So if you sold in 2024, you got to do it in 2024. Now it's at 60% this year, but we're hoping, and it sounds like it's probably more probable than not, that with the new administration with Trump, you're looking at 100% bonus depreciation coming back, which is a huge, huge deal because it creates what we call tax flow, and tax flow drives the values of properties. It also drives the economics of these deals. Mike, you want to touch on that piece right there?
Sure. So what you just described is demand creation. Right now, we are recording middle of November 2024. Lots of my friends are real estate professionals. They are investors like me. And they're all reaching out and they're saying, Mike, what do you got this year? What do you have depreciation deals? And I tell them, this year I can't get you anything super exciting because of 60% bonus depreciation. The moment you go to 100, you have 40% more of potential bonus depreciation through cost seg. So we're gearing up for early 2025 deals that will be picking up heavy depreciation benefits. And it's a demand creator. Very simply speaking, folks have the opportunity to sell assets that they need to sell, pick up new investments, especially if they can pick it up at the right price. Deep buys, discounted deals. Multifamily has gone through some level of valuation corrections as a result of higher for longer interest rates. And getting these deals are hard, but when they do show up, they really show up as very deep buys. And then if you can layer that with massive depreciation benefits, now you got a home run deal. And basically, you could think of it this way. Just give you an example of one of these deals that we're working on right now. We're talking about a deal where we think we can acquire it in January and structure it with the obviously bank debt, add additional, what we call it preferred equity, that quacks like that, acts like that. It doesn't take any depreciation benefits. So you take that preferred equity, you take that debt that gets primary debt that has no depreciation benefits. And what's left is all depreciation benefits flow to common equity. And when you run the math, we just came up with a math of at least 2.4x. Means you write $1 million check, you get $2.4 million in depreciation benefits year one.
Okay, pause here. This is really important, right? Because what Mike's saying, I want to kind of pull it out. So because we can leverage, and why multifamily is a great way, because it's typically going to get 70%, 75% LTV, meaning for every $1 million you put in, let's just keep it simple. Let's just say you get $3 million worth of a property. And so you're leveraging the down payment to buy more asset. Now that land, let's call it 20%, is typically, you can't depreciate land. So we got to take off of the $3 million purchase price, 20% or so, maybe 25, let's say 20%. So you're going to drop down. But that leaves the rest of it being building or structure, which then can be depreciated and accelerated. And a lot of it, a big chunk of it can be in year one, right? And that's what we're saying. And so what Mike is saying is it's huge that you can produce these massive losses on paper losses, right? By accelerating this depreciation, which then if we add into this, the ability to be what's called a real estate professional, Mike, let's touch on just how exciting this can become for the entrepreneur who's also investing into real estate on an active basis.
That's right. So you, Brad, you covered exactly the math. It literally, on a lot of these deals, multifamily, classic picture, you buy $100 million asset, and literally we're working on a deal about that size, with the first year bonus depreciation about $30 million. And then just to be very clear, yes, land you can depreciate. So you depreciate everything you can. You bonus essentially all the, let's call it the carpets, the appliances, everything other than the walls and then the foundation. So you bonus, depreciate, accelerate all of it, and you wind up roughly, let's call it 30 million. And by the way, you could also include new construction. So if you're doing value add work, you're doing a whole bunch of additions, you can bonus depreciate that too, in essence.
Pause real fast. Now on the 100 million, you're taking out the 20% for the land. So then you have 80 million, right? Left
Yeah.
of structure approximately. Of that, you're saying 30 million in year one. Is that with the
It's
40%?
it's 30 million of a rough total cost in year one. So
Okay.
I'm just generalizing very high level. So
Yeah,
if you're buying
generally
for
speaking,
100 million,
but is that based upon the 40 the because right now we're at 60% right now, or 60 or 40,
we're
or
at
60.
60.
60. So is that on 60? Now what
No,
if
on
we're 100?
100. That this is based on 100.
Okay,
So
so if it were
right now it
60,
wouldn't be 30. Right now it would be more like 18.
okay, so that's huge, right? So that's where we're hoping that the bonus comes back in at 100%, right? And they go permanent, and they keep that because it would be different between 18 and 30. Okay, now keep going.
Yeah, so you take 30 million roughly, it's just high level math. And then you have primary debt and then you structure preferred equity. And the ultimate question is how much common equity you need to raise in the deal. So just for sake of simplicity, say if you're raising common equity of 12 million, you divide 30 by 12 and you come up with your ratio. So, and if you only raised 10 million, that's all you needed, and you had 30 million bonus depreciation, you'd be at 3x. Literally, you put in 100, you get 300 of loss in the first year. It's incredibly powerful. When we do these computations, we usually project conservatively. So again, I gave you 2.4 ratio because I think it's very, very achievable. Might wind up being even higher. So that's how it
Pause here. Pause here.
functions.
We're pull this thought out here, right? This is really important, right? So what we're talking about here is called tax flow. That's what I like to call tax flow, right? It's basically figuring out ways to compound your wealth through depreciation and loss by leveraging what we call debt flow, right? Now here's the key: it's got to make sure you have cash flow. And where people got in trouble these last couple of years is they let one of those get out of whack, and that one was called the debt flow. In fact, they let debt reset on their deals. They didn't fix it, and it's sinking the ship, even though the tax flow and the cash flow actually were really good. Now, by definition, once the debt flow doesn't go well, your cash flow doesn't go well, right? Then they sink ships. But basically, it's like a house of cards. You got to make sure you got all three of these that are lined up with a proven operator that are buying a good deal at a solid basis, right? That have the ability to force appreciation. There's a lot of things you want to make sure you go right. But what we believe, and I think Mike will agree with this, that this window of opportunity is great because we saw such people that overpaid, that are losing and or have to sell at a discount. And then if this bonus appreciation kicks in, and if interest rates eventually, come down to a little bit more normalized level, or some could say they're normal now, but just a little bit lower level, you're in great shape. Mike, any thoughts on that?
Yeah, exactly. So what you just covered is a great wisdom. You also have to buy right. So this cyclically, last couple of years, if you bought at the peak and you structured with floating rate debt, you're being squeezed by the debt. So even though you got tax benefits, but your risk profile on the equity was high. Today, you're coming in, still equity is the highest risk on a capital stack, but you're buying at a much better price point. So give you an example, this deal we're talking about, we're looking to buy at 8.5 cap rate on the as-is cash flow. So it's insane if you can pick up a deal, multifamily 8.5 cap, right? You basically you're going to start with a cash flow on day one just because of the how deep you're buying. But if yes, a couple of years ago you bought it wrong, you gave all the cash flow to the debt service and the interest rate spiked, then you're being squeezed today. That's what's driving some of these deals today because the owners are squeezed pretty hard.
By the way, and if you fully depreciated, had all the tax write-offs, and you had to sell, it could potentially recapture. Even though you're losing money, you could still have the tax to pay, and that's the scary part, right? Or all of a sudden someone goes, "I put X in, I'm getting Y back, or a portion of Y back, if anything back, but I had all this tax." It could still recapture. People have to be aware of that. Does that make sense, Mike? Or any thoughts on that?
Yeah, I agree. I absolutely agreed. So this bonus depreciation, it's a pseudo loss. Depreciation is a pseudo loss. You take it at some point when you sell the asset, you have to recapture. It may not be a recapture in many ways. It could be a capital gain, but your basis has been lowered. And then you started this whole conversation how you leverage this up with the real estate professional status. So REP status, again, I'm not CPA, I don't play one on TV. We're just discussing these things purely strategically. So, of course, with the advice and consent of your CPA, you can become an REP, spending 750 hours minimum per year. Also, making sure it's your primary trade. If you own a business, a very successful business, you could turn from a CEO to a chairman of the board. and you can turn to be a real estate professional, developer or investor, and then you can potentially qualify as an REP. But as an REP with the proper grouping election, again, these are all technical terms, but you can get to the point where you take the losses from a deal like this and you offset them against your other income from your business practice or whatever you operate.
Yep. And by the way, these are all the things that we encourage you to check with your personal CPA. And by the way, you can learn more about Mr. Mike by going to bigmikefund.com, bigmikefund.com. Is that the correct email address?
Yeah, it's a cheesy name. It sticks, and if you misspell it, you forget the at the end. Bigmikefund.com. I promise it's not a kinky site.
Yeah. And okay, great. So we talked about the 1031 exchange, and the lazy man 1031 exchange, pigs and pals. I also want to bring to attention, like if you're in a asset that you're selling and you're in a regular 1031, one of the downsides is you have to put all of your equity typically in one other deal, and you have to do it all yourself, right? And you don't get the benefit of buying into these large opportunities like Mike's talking about, right? Where you can get a lot of scale with management, a lot of scale with operations, and essentially even scale with debt on better terms. Banks like to loan to larger opportunities.
Exactly.
And so what we're saying is not even have to do the 1031 at all. Like you literally eliminate the need for the 1031. You can still go for the 1031 and let it fail. If it's in the same year, that's the key here. You're going to run out of time. Careful on this 45 180 because exchanges cannot fail until day 46 of your exchange. And that is if you de-identified everything, all right? So someone might say, well, okay, great. I want to go for my 1031, but I'm going to identify these properties. And then I sold in 2024. And well, guess what? You identify the properties and then you go, oh, well, I stay 55. And I go, well, I want to do Mike's deal. Let me just get my money out of my exchange before the end of the year comes. Well, guess what? The exchange accommodator says, no, since you've identified, you either got to close on those or wait till day 181, which does then what? It kicks you to 2025. And then this whole lazy man 1031 falls apart. So you really got to understand the intricacies of every strategy that you're going into and the timing restrictions and the if-thens. And so we do have what's called the best 1031 exit plan, which gives you the option for a regular 1031 exchange, an option for the deferred sales trust, but also helps you to navigate through these things that we're offering, right? Which is really important. So let's just say day 30, you call me and you say, Brett, I want to do one of Mike's deals. I say, great. You need to de-identify right now by day 44. So nothing's there. So on day 46, we can have the funds sent back to you. Then on day 47, 48, you can just put it with Mike's fund. Like this is what we're talking about here. You want to make sure that you have a team to help you execute this because you miss one of these little pieces and then you're in regret and now you're chasing, the tax. Is that making sense, Mike? Any questions on that?
Yeah, it's very powerful. You need tax strategists, not just tax compliance CPAs. And the tax strategists can go look and help you. A lot of questions we get from doctors, dentists, other professionals who looking to exit the practice, and then they have significant capital event. And what they do is they don't think about advanced planning. Sometimes you have to plan a year in advance, 2 years in advance. And again, your DST is so powerful from the point of view that you could sell the practice in the building, put it all in DST, and then use us as a vehicle to deploy the capital in some of these deals. Honestly, today, the way we look at a lot of these deals is they have to, the most fundamental question is this a great deal? What's your risk profile? What's your return profile? And we have to feel very, very good from that perspective. All this tax planning is wonderful, but if you get yourself into a challenging, high-risk deal and the deal malfunctions, nobody wants to lose money. So rule number one, don't lose money. Of course, in this world, we've seen this rule violated in the last couple of years. But today, you're actually looking at a great time from a cyclical perspective. And these strategies become so much more powerful if you come in into great deals and then you layer that with this lazy 1031 and then DST maybe on an exit, you really have multiple benefits.
Absolutely. And by the way, it's not a one size fits all. And I agree with Mike. There's really, I think, four major things you want to look at least. He said risk profile. He also said, return, needs or wants or, desires. I also think time horizon. You really want to look at that liquidity and non-liquidity needs, right? And then legacy. And I think the fifth one would probably be past performance that you have personally done or invested in, and your understanding, right? Because I think investing is conviction and certainty of conviction of where you've been and how things are going to turn out, so you're not acting emotionally. And the more experience you have in like the real estate or the business world, right, the more understanding you're probably going to be more comfortable in the real estate or business, or lending world, right? It's simpler versus the stock market, that can be a lot of things out of the control. So I would say that. And then also the deferred sales trust, I'll touch on this real quick. The deferred sales trust, what's neat about it is it gives you these things in a variety, and there is no timing restriction. Even the lazy 1031 has a timing restriction because it's the same year. Especially if you're selling in the fourth quarter, you've got to make some quick decisions before December 31st. Now, if you close January 1st of the year, well, you've got 364 days, which is good, right? But if you close the year before, you don't on the lazy 1031. So you just want to be aware of these rules. It's kind of like in a Rubik's Cube, Mike, right? And you got to try to get the line, cut the colors of red, blue, green, yellow all lined up, and you're moving this. But you're right. You want to work with strategists, and you want to define what you're trying to do, and then you want to try to put the pieces together as best you can. We're here to help you. Mike and I both would love to geek out with you guys about all of this, so feel free to reach out to both of us. Mike, any thoughts before we move on to the lightning round?
No, it makes a lot of sense. And one of the really important elements you mentioned is sort of diversification and capital allocation. All these wonderful real estate deals that are awesome, love it, but they are generally illiquid. So very simple. The comparison between stock market and real estate market. Stock market, you can press the sell button. With the real estate, especially private real estate, you cannot do that. So a lot of the deals do have a time horizon, and you just really have to understand that sometimes it takes a little longer. Sometimes they fly off the shelf and go faster. We've seen this rodeo many times before. When the markets are good and hot, you can have a deal underwritten for 5 years, fly off the shelf in 18 months with crazy returns, right? And then you may have a deal underwritten for a fast flip, and then you wind up stuck for 5 years. So you really have to understand part of the underwriting process is to kind of look at the deal flow, the business plan, and then when do you expect to get capital back? Because some deals today, what's really interesting, the refi play may come into the discussion again. Years before, they used to be buy the property, conduct value add work, then refi, get a bunch of money back. Or there's other strategy to get capital back. So getting access to capital back, or at least understanding the timeline, is critically important. Like on this deal, we're talking about massive improvements and utility reimbursements, right? That can return a lot of capital through programs available for installing brand new furnaces or installing brand new energy efficient windows, etc. So all this matters. And then where do you get liquidity? Well, you got to have some other investments in your portfolio that are more liquid, maybe debt, shorter duration, shorter maturities. And honestly, I'll tell you this. We run funds and syndications, and I've seen massive shift in the mental thinking. I would rather be in a deal, 2-year debt deal or 3-year debt deal, than being in a 7-year fund. And I mean this with all due respect, because people want predictability.
100%, especially, and I think cash flow is more king than ever before. My clients are liking to be into what I call semi-liquid, right? 30, 60, 90 day-ish, right? With lending, a lot of lending, or even a year or 2-year commitment, but have a heavier cash flow. Like that is predictable, durable, first positions, very strong, right? Versus, more maybe upside potentially, but longer time horizons for the development, right? They'd much rather be in the value add now, where I get some cash flow, but some good upside. I'm seeing the development can be a little bit, people aren't wanting to wait as long as my instinct with my clients. But that being said, Mike, are you ready for the lightning round?
Let's go.
All right. Knowing what you know now, if you can go back to your 20-year-old self, what's the one golden nugget? Make sure you tell yourself to do.
One more time. That was really fast. I didn't catch it.
The golden nugget, like this is the wisdom piece. If you're 20 again, you could tell yourself the one big, wisdom golden nugget. What would you tell yourself to do?
Invest heavily in Roth IRA.
Okay, invest heavily in the Roth. Okay, perfect. Question number 2, number 1 book you've gifted or or recommended the most in the past year?
Richer, wiser, happier.
Rich, wiser.
Richer, wiser, happier.
Got it. Okay, perfect. Question number 3, the number one way you're using ChatGPT.
A lot of articles. I write articles. Our team cleans them up using ChatGPT. So I create the content. The ChatGPT cleans up the language.
Perfect. Next question. What are you most curious about right now?
Honestly, I'm a little intrigued by AI in general, but I am kind of an old dog. So I'm more curious about some of the changes in what Trump is bringing back, old values. So what I would rather see is back to the past, bring traditional conservative values to the world, and I mean this in a great way. So before we get into deep future, can we come back and find something in our roots a little bit more to what I value? Just kind of, maybe it comes with age, so you get more appreciation for what the parents taught you instead of some of the craziness, some of these ideas that have been floating out there that I think sometimes they're very insane ideas. And I just hope we go back to a normal, good, common sense world.
Well said. Next question. Number one leadership quote or theme that you strive to live by.
Leadership is all about 3 things only, and I live every day. I'm a leader. I have an organization and a successful organization, and leaders are all about people, culture, numbers. So as a leader, I have to be in the people development business, not necessarily in the management. So culture, making sure we have the right people on the bus and they're rowing in the right direction. And numbers, we just got to know the numbers. So leadership is about those 3 things: people, culture, numbers.
Awesome. Hey, Mike, it's been more than a pleasure to spend some more time with you. I want to thank you for sharing your wisdom with us. I want to thank you for sharing ways to help people create and preserve more wealth with the lazy 1031 exchange, real estate professional status, even touching on the deferred sales trust. Thank you so much. For our listeners who want to get in touch with you, would you mind one last time, what's the best place for them to find you?
BigMikeFund.com. That's the best way to reach out.
Awesome. And also want to thank all of our listeners for listening to another episode of the Build It to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast. And our goal is to guide successful entrepreneurs and investors like yourself on your journey from millions to billions, because that's a journey we're on, right? Where we believe that the best way to scale your business and compound your wealth starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. And again, our ultimate goal is to help you scale and compound your wealth in life so you can give more or all of it away. I'm Brett Swartz. We did touch on the deferred sales trust. And if you want to get started with that, we specialize in that exact thing. You go to capitalgainstaxsolutions.com. You can also check out the book that we came out with called Building a Capital Gains Tax Exit Plan. We have Kevin Harrington from Shark Tank and other really, really smart people that are in the book. Check it out on Amazon or just go to capitalgainstaxsolutions.com to get started. And we appreciate everyone listening, watching out there. Please rate, review, subscribe, and share it with someone it could be a benefit to. And we'll talk to you again real soon. Bye now.